Investor is probably one of the best value investing books ever written. This is literally like the Bible of Warren Buffett and Benjamin Graham, Charlie Munger. I think that's how you pronounce the name, Charlie Munger. These guys basically, wrote the book and created the concept about value investing. What I first want to say is this book is amazing. It has so much valuable and dense information in it. However, I don't recommend this book to read to many people, and the main reason is it's a textbook. It has so much information in it that the majority of people, it's just not needed. Even like for me, I don't think I needed like 80% of this information in the book. However, it's good to, get all the information, decide, what do you want to use in it, what do you need. And that's, I guess, the important part. But for the most part, this, again, is a textbook. An example, I just have this book with me. If someone wants to learn about robotics, I don't give them this book. This book is like it has so many equations and things that are unnecessary to an average person about robotics. You just don't give them that book. For this book, this is why I don't give people this book or recommend it, because it's the same thing. It's a textbook. This could take you a year to go through and study, take notes, and learn to apply the principles. With that being said, I think I got it for like $25. That's so cheap. Normal textbooks, most textbooks cost like a couple $100. Like in college, my textbooks would cost, on average, probably $150, $200. It's ridiculous. I mean, that's kind of like scammy too, and that stuff. But at the end of the day, the amount of money you pay for the knowledge you could gain from this it's the ROI, I guess, is very good. So yeah, this is a textbook. This is not a book you sit down and at night and you read and you have your little coffee, or in the morning you wake up, you have some coffee. You grind this book. If you want to learn from this book, you get out a pen, a highlighter, and you got your game face on, and you're ready to try to absorb whatever Benjamin Graham and they say, and try to translate that into your own life and investing principles. I read this book, I think, 2, 3, probably 4 years ago. It took me an entire summer. I highlighted stuff, I did some note-taking, however, not enough, not as much as I should. I think I do want to go back and read, at least, I do reference some excerpts. Actually, wait a minute. I remember last Christmas, last Christmas I started reading this book again. It was more like going back and seeing the things I took notes on, and then I made like a piece of paper with just notes I thought was important from this book. However, I think I want to go back and just read it. Let's just talk about some stuff that's in the book. Now, this is obviously the revised edition, and it's got so much stuff. It basically walks you through everything. If there's literally one book, you're like, I only want to buy one book about investing, even I guess trading, but now it's just basically value investing, or just stock market, how to make money in it. This is probably it. But again, for most people, it's not needed. It's too much information. They got investor inflation, they got, speculator. Who's a speculator and investor? They classify two different kinds of investors. One is like a speculative investor, and the other is a defensive. I guess right now in my life, I'm more on the speculative side. However, I do have defensive investments to support my speculation, so I'm kind of in the middle. I mean, that's what most people are. However, again, I would fall into the speculation. And you got, the general portfolio, like what the values of a defensive investor. They got like stocks the defensive investor should pursue or try to find. They got investor market, how to get over market fluctuations. Basically, they have the original version, I think, from what Benjamin Graham wrote, and then they have the commentary on it that kind of puts it in today's practical terms and kind of thins out the information to make it more readable almost. Again, this is kind of a tough read. It shouldn't take you a week to read this. If you read this in a week, you did it wrong. Maybe even a month, you did it the author try to convey to you and how to use it in your life. We got investing in funds, we got just literally everything, earnings per share, things to look for. Now he goes over specific examples in history, comparing companies. These chapters you could spend like a week, not a week, but you could spend I remember spending hours just trying to compare. I don't know. It's just dumb stuff, I guess, but I really wanted to try to understand it. Yeah, there's a lot that goes into this. So we got a preface by Warren Buffett, his Benjamin Graham's student. I'm just gonna flip through some pages to see if I can find any things that I remember highlighting that I thought was really important. Again, this whole book is important, but you can't take notes and just rewrite the whole book. You have to find things that are specifically important for you. So I guess, this is an important kind of quote. So what does basically an intelligent investor mean? It means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. This is important, I guess, for many aspects in life, but also, obviously investing because you're putting your money into, things. But in today's day, I think trading is even more important because it's very hard to find value right now in this type of market. I'm not some ancient wizard. I've been trading for 20, 50 years or whatever, but I think it's clear to see that finding value is a little bit harder than it was. And so shorter term trades might need to be placed, but you have to, again, think for yourself. That's my thoughts, my emotions, and how I'm reacting to it. It might not be the same for you, Oh, this is a good quote. This could be labeled right now for Zoom, for even Apple, even Amazon, CRM, just obvious prospects for physical growth in a business do not translate into obvious profits for investors. So right now, let's say Zoom. Zoom is a good company. Companies are picking up on it. They're using it. And the stock price is, again, maybe 80, 90 times sales. That is so overvalued. This is not something that Benjamin Graham or whatever would ever want to invest in. It doesn't make sense. Just because the obvious profits in the future might come in doesn't mean it's going to be obvious time to buy for you because it's not at a value right now. I guess that was kind of an example, but definitely kind of one reason and one way to interpret it. This is one of the reasons why I always invest in dividend yielding companies. It's kind of something I guess I learned from this book, but also I wanted to translate to my own investing principles. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. When you invest in a dividend aristocrat, let's say, I use the example Pepsi all the time. I guess that's not even an aristocrat like Coca-Cola would be. Coke has been giving out dividends for, 50 plus years maybe. And they've always, paid them out. This is an investment that's not speculative because you have a almost 99.9% guaranteed percentage dividend return on your investment each year. That's very defensive. If you invest in, I'm not going to say Apple because they have a dividend, but let's say again Zoom, it goes up maybe 10% every quarter, let's say, on average. That's not guaranteed. It doesn't have that. The guaranteed part is what makes a defensive investor super defensive. That's something to keep in mind. And that is why when I invest and buy companies, I need that dividend because, again, it's almost a guarantee. Sure, there are risks involved, but it's a lot less risky. Basically, in this section, investing versus speculation, he talks about, dollar cost averaging and basically its importance. I feel like it's pretty known now on the internet how important dollar costs are important and effective it is. It's pretty basic and just something you should incorporate into your investing routine. And this book is just loaded with information. This was definitely one of the most powerful. Oh my gosh, I didn't realize it was in this book. I thought it was somewhere else. Why do you suppose the brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell, no matter what the market did that day? Because whenever you trade, they make money whether you did or not. This is why even in again those robotic trading books, the AI, it doesn't matter. We're us retail guys are just this is where he talks about specifically speculating and kind of like 3 rules, Basically, you never delude yourself into thinking you're investing when you're speculating. Again, you have to separate that construct. There's 100% a difference. Speculating becomes morally dangerous the moment you begin to take it seriously. This is why, right here, this is why I will never, full-time trade. Because it's just a game, and you're not going to win most of the time. It's the same thing with, gambling. I'm not going to say trading is gambling, but it's close. There are definitely similarities, and you don't want to put yourself in that stressful situation of always speculating and trying to, there's a big topic at hand here. I don't want to get into right now, but it's just too risky and stressful. You don't want to, again, being a professional trader, most people don't even make the money from trading. They make money from other sources, teaching it. But at the same time, you can become profitable in the field. It's just very hard, very stressful and challenging, and you gotta get lucky sometimes too. And yeah, you must also put strict limits on the amount you're willing to wager. This is why in my portfolio I always have that about 5 to 15% range, where I have money in very speculative things where I'm just hey, I think I'm looking at the price action, I think something's gonna happen, and I take that wager. But I'm willing to cut my losses, and I'm only willing to bet a certain amount of my portfolio in case something happens. I don't bet the house and lose, or bet my whole house and take the big hit. This kind of brings up I feel or I hope that my channel, although we do focus on technical analysis and that type of trading, I don't come off as this kind of person that just trades all this stuff and makes money, because I don't. I have my portfolio that I kind of manage and move around, and I like to look at things that go around in the world. And then I have some trades where I'm hey, that price action's looking kind of spicy. I'm gonna hop in and see if I get some, small gains. Because I feel that's a more realistic approach than trading these, how other people might illustrate on YouTube. Because that's just what I hope my channel comes across as, but I don't really know, to be honest. Mr. Graham talks a lot about, here he talks about inflation and stuff, and a lot about bonds. I kind of skipped over the bonds part because I didn't think it'd be that relevant in my life, or right now, because I don't want to buy them at all. Just remember the money illusion. I feel most people watching this channel right now understand this, but if inflation's 2%, and if you receive a 2% raise, or say 2% dividend, but inflation's 4%, you actually lost money. Just remember, inflation is powerful. Don't want to forget about that. That's why you always want to make sure your yield is kind of high, or at least growing on dividends, because, it's dividends better than nothing, right? But it's just inflating, one thing, no one should ever invest in a company, no matter how great its products or how crowded its parking lot, without studying its financial statements and estimating its business value. That's one thing I always do. That's why I have that huge Excel spreadsheet. Before I put money in any company, I like to know where are they on a balance sheet, where's their cash going, what is their last 8 to 10 years look like? Are they growing? I also like to look at kind of what the economy's doing. Is there economic, should they be improving as much as other companies in their little niche? You gotta have some physical understanding and kind of estimate again, what should this company be worth? I don't really estimate the business value too much because it's pretty challenging, because I don't know how much a $100 billion business should be, but I know comparing it to others, as well as just studying are they fundamentally sound? That's basically what I'm saying. Uber, if you are invested in Uber, you have no understanding of how destructive that company's balance sheet is. Not even balance sheet, it's everything. It's such a bad fundamental section, he talks about, finding bargains and valuable companies, kind of like how do you know a company's at a bargain? I'm not gonna get too much into that because it gets pretty complicated. It talks about earnings and stuff here. So here we get into like market fluctuations and investing, and I have if you want to speculate, do so with an open eye, with your eyes open, knowing that you will probably lose money in the end. Be sure to limit the amount of risk and to separate it completely from your investment program. That's basically what I'm doing now, like even with this channel. Again, I reiterated it, or I said it about 5-10 minutes ago. I have more portfolio than I have money where I'm like, I'm gonna try to get these price fluctuations and trades because I think it's fun, and I mean it's fun too, but I think I can make some more money, and it has been working, especially in this type of market where things are basically only going up. If I can limit my risk by not being in a trade and getting in and having that time or being in it for a certain amount of time, I'm limiting some heavy downward movement if we might see it in such a high valued market. Here's another thing I want to take note: your money and your brain. Humans are pattern seeking animals. One of the things is like in price action strategies and stuff, we look for patterns, and sometimes, most of the time, it's deceiving. However, there are some, if you can form, and I gotta be careful with my words, but if you can form an educated reason or story as to why a certain pattern in price action is forming based on other people's psychological reactions, I think that's when patterns can be relevant. That's why it's important to separate these patterns you see and to only study specific ones. Because this is why when I look at charts, I only look at the charts for anywhere from 5 to 10 seconds. If I don't see something that quickly, I just look away, because if I see something I like, I continue looking further to seeing if it actually is something. But if I look at, like, if you give me any chart, if you give any human any chart, and you say find the pattern, they'll make up a pattern that they think they see that isn't actually there. That's why it's important to even understand yourself. Like, I know me, if I look at a chart for a minute, I'll find something that I'm like, wow, that's interesting. But the correlation is not causation. You have to separate with what is, with what actually you might be like brewing in your mind. Patterns have their place. Some of them are legit, based on certain, it just happens. But for the most part, a lot of these patterns we see in price action is just nothing. And it's just our brains tricking us. That's why we have to be careful, but just something to keep in mind. Here he talks about EPS and stuff like that. Very important chapter. I think I read this a few times. He talks about dilution, probably also stock buybacks or something. Yeah, very important chapter here. I mean, honestly, all these are important chapters, but this is one thing. Even Benjamin Graham identifies the risk is not in our stocks, but in ourselves. Most of the time, people have good decisions, and they act upon those decisions, and then they trick themselves into thinking otherwise. Or the other way around, they think they are too good. They do dumb stuff that if they just thought a little bit further, they might have, saved some money. The biggest enemy, even in stocks or investing in trading, is definitely ourselves. Because our mind is not programmed to do this type of stuff. It's just not. That's why we need the patience, the discipline, and the thought process. That's why when I do a trade, or I guess invest, I write down reasons why I'm doing so. I list it out. I make a video about it, discussing, like my last video, ExxonMobil. I think I did a 20-minute video discussing why I want this company and why I think it's a good buy right now. If I am starting to unwaver from my opinion, I can go back to that video and listen to myself in that moment. I also keep a journal of trades and stuff that I have, and before a trade's placed, I know what I'm doing at certain price levels, certain things, because I know that if let's say shoots up 10% or shoots down 10%, I gotta know how I'm gonna react. I can't do it on the spot. Your minds don't work that way, or your minds don't make the best decisions when you're in this panic, like stressful mode. That's why if you have it all laid out already, you can, create or generate better decisions. Your brain, or I guess might react a certain way, I can have a better understanding of me and how to, I guess, just have a better experience if something were to happen. You gotta really know yourself if you want to be definitely a good trader, good investor too. But you just gotta chill. Like, that's why, again, if you're watching ASMR, that's one of the reasons why I did ASMR too. It really helped me in my life just relax and not even let go, but it gave me an outlet and a thing to go to when I was stressed and I didn't, and I had decisions to make or things to do. But the best thing to do in that time was just to do nothing and let it happen. And just listening to ASMR made me relax, made me chill out. And I guess a quick example, just to kind of make it make sense, is one year in college, I failed a bunch of exams, and it was really stressful, and just thinking about it all day and all night, just like, oh my gosh, I'm failing this course, or blah, blah, blah. And then I found, I started listening to more ASMR, relaxing music and stuff, and it really changed my perspective on life. Because I wasn't sitting there fidgeting, like, I gotta with this exam, or playing a very angry video game. I went to someone else's, YouTube channel, and they gave me this sense of calmness that, yeah, it sucks, the spot I'm in now, failing stuff, but, do better tomorrow. Or you just relax now, go to bed, have a good night's sleep, wake up refreshed, and start the day. I guess I'm getting more into a psychological discussion, but that is a very important part of investing and being in it for the long haul. This book, again, it's beautiful. It's massive. 600 pages of just pure information. It's just straight up information. I don't recommend it to everyone. It's just too much information. It's too much stuff. But if you do read it, take your time, take notes, highlight, understand, and more importantly, figure out how you're going to incorporate this new information into your life. You might need to read this a couple times, or go over some parts. That's completely normal. You're not dumb. This book is just very dense, very heavy. But yeah, anyway, this book feels so nice. I love this. I hope you enjoyed my video. I know most of you probably already read this book because it's so popular and so good. But let me know what you guys thought of the video. If you have read the book, what are some of your favorite quotes or lines in it? And yeah, thank you all for watching, and I'll see you in another video.